right, how's it going, guys? My name is Caleb Kioh, founder of WalletGyde, and we are here in 2026 at WalletGyde's new podcast series. We're doing how to build your financial A-team. And I tell you what, guys, I have quite a lineup of speakers here. Fortunately, I've actually worked with all these speakers in the past, and boy, each time I talk to them, they always bring some really awesome insights. One in the advisory space, another in the tax space, and another in the banking space. And so there's one thing that I get excited about when it comes to personal finance is it's all about the financial journey, right? It's all about one's, money story. And one of the things that I started learning about in your money story is having a team to, take you from point A to point B to point C. And that's quite honestly what this podcast is all about. It's all about bringing together those different financial professionals that consumers and individuals are going to need to speak to along their financial journey. So without further ado, let's just welcome each speaker. We can start with you, Connor.
Yeah, well, Caleb, first of all, thank you very much for having me here today. It's
Absolutely.
a pleasure to be able to talk alongside of you guys and shed some light just on our industry. I specifically work as a financial planner. I've been doing this for about 10-ish years, and it's been an awesome journey, I got to say. I work with some incredible people, and what got me into this line of work is just people itself. So that's just a little bit more about my background.
Love it.
I'm a father, husband, got a 2-year-old daughter, and one on the way. So that's my other hat that I wear, my most important hat.
Love it. And financial advisory is your space, right?
Correct.
Yeah. So you're here to impart that financial, let's say, wealth advisory. I'll say share. Talking about personal finance through the wealth advisory lens, correct?
Correct. Yeah. There's a handful of hats that we wear, but I would say the three dominant areas that we really focus in specifically as financial planners is, the wealth accumulation side, the risk management side, which is, insurance specialty, and then also the planning end, which is just making sure that everybody that we work with will know that they can retire by a certain age with a certain lifestyle, or how to put their kids through school, pay off debt, and stuff like that.
Love it. And, along that journey as well, as you're looking to build wealth, I know taxes is very important, right? Right, John? So you're here to share that lens of taxes. Could you, just kind of tell us a little bit about your background and how important taxes is when it comes to, your financial story?
Sure, yeah, definitely. Well, I'm a little bit on the other end of the spectrum than you, Connor. I have 2 children that I'm trying to successfully launch into adulthood. One up at CU and the other up at CSU. So we're a bit of a divided family.
Divided house.
And yes, I have been in private practice since 2004. I sign probably 600 income tax returns a year.
Wow.
Several hundred sales tax returns a year. Several hundred employment tax returns a year. Couple of dozen estate tax returns a year. And so I have quite a bit of experience in the tax space. I think one of the most alarming things that I've seen most recently is when you have to cope with government overreach by overzealous revenue agents and revenue officers, both inside the Department of Revenue here in Colorado and with the IRS. And so I take pride in making sure that I'm protecting my taxpayers with every tax return I sign.
Awesome.
So that's
awesome.
pretty much who I am.
Yeah, very important, as you can already hear, the role that you play, John, and another very important role when it comes to, building your financial story and your financial journey is banking, and so we have none other than the best of the best, Ben here. Could tell the audience, about your background and the importance of banking.
Yeah, I'm currently the market president for Alpine Bank in Northern Colorado. I just celebrated my 21st year with Alpine Bank, so I've been in the space for a long time and really focused on relationship banking, everything from consumer to commercial lending, and just helping people with their overall banking relationship and been a lot of fun. It's been a very satisfying career to get to meet so many different people, help realize their dreams and help them along the way, and just created some fantastic relationships. And obviously great to be here with you, Connor and John, as I think those are really the three most important legs of that stool to have for people as they kind of grow in their financial journey, is the wealth side, the tax side, and then obviously have a really strong banker. And I know I said this on our first podcast, get yourself a banker, not a bank. Anybody can have a bank, but make sure you're seeking out a banker, a trusted advisor in that space, somebody who truly invests in you and wants to help you through that journey. So
absolutely, so important. So as you can see, the Avengers have assembled, right? So the financial Avengers, so we have a solid team here. So I'm so stoked and excited to do a deep dive about, personal finances through these different lenses. And I think a great topic to start off with is, at the end of the day, I remember going to financial school and learning about, the stock market and this and that and the other. So, the thing about finances is it can be very high finance, right? It can be very jargon, and it could be sometimes, unfortunately, out of touch with a lot of consumers. And, the reality is consumers are having some real pain points out there, right? There's some true challenges that young professionals are facing. And I can even just kind of go through some of the pain points here. There's a lot of them living paycheck to paycheck. There's a lot of, high prices, low income, right? Student loans, fear of investing, all these, on and on and on. So I want to kind of start off with, instead of us talking about interest rates and what the Fed is going to do, let's talk about the pain points of young professionals and like the real day-to-day problems. When you talk to, and you guys can kind of go and from here we can have a nice dialogue. When you talk to your clients, particularly young professionals, what sort of common money challenges do you typically see or hear when you talk to them?
I would say from my end, you hit the nail on the head, Caleb. The first, I'd say, especially with younger audiences, millennials, the biggest issue we run into is just managing a budget. It is really hard to do, first of all. In fact, this is ironic coming from a financial advisor, but I'm not a fan of budgets, as crazy as it sounds, because they do change month to month.
Yeah.
The discretionary spending section will always be different. And we all know this just over the last 2 months. If you look at December versus your January outflows, it's night and day. So when I meet with young professionals, aside from assessing what their financial goals are that they'd like to achieve throughout their journey, the next thing that we do immediately is we'll outline a budget together so they know really what kind of boundaries or guardrails that they can spend within, and also, if any, what kind of saving capacity they may have to set aside money towards their future.
So important. I mean, if anything, to even piggyback on that, I mean, you mentioned the budgeting aspect is absolutely, I would imagine, so important to kind of get to the investing part of things. Here at WalletGyde, we like to talk about the 50-30-20 rule, those sort of very principles, pay yourself first principles, and all these principles to help one start off from that budgeting to get the disposable income, get their discretionary aligned in some sort of allocation. Because if anything, in the wealth side, they talk about wealth allocations, right? You know how to strategically allocate your funds when you invest, but what about like your day-to-day? What about your budgeting? It would be nice if you can allocate, when you make money, where that income goes to different sections of your expenditures, right? And I think, the 50-30-20 rule is not like a rule you live by and die by, but for sure you can adjust it. And I would imagine that helps out on the budgeting side of things. Or do you support it, or are you?
Yeah, absolutely. To elaborate, the 50-30-20 rule means, 50% of your cash flow goes to overall fixed expenses, and then you ultimately save about 20%, and then you spend the other 30%.
Yeah.
Most recently, I would say in the last decade, or I should say throughout the century, we've noticed a decline in pensions, and there's increasing fear on Social Security. So a lot of us professionals within the planning realm and saving money, we're recommending more of a 50-25-25 approach.
Interesting.
So spend 25% and save 25% to get on a more safe shot to make sure that you can retire the way that you want to and achieve a lot of your goals.
So you said 50 with your needs, 25 with your wants, another 25 with your savings and debts. Okay.
Best way to put it right there.
Okay, like it, awesome. And so now let's kind of transition to following up with that same question with you, John. When it comes to common struggles that young professionals go through in the tax world, how does that look like?
Well, I think most young people today, one of the things that we see, my team and I see, is when they're getting their first job, they struggle understanding their worker classification, whether or not they're a gainful W-2 employee. In other words, they have income taxes and Social Security taxes withheld from their pay, or they're an independent contractor and they're not having taxes withheld from their pay. And oftentimes we see younger folks, sons and daughters of our clients, come to us not realizing that they have been incorrectly categorized by their purported employer as an independent contractor and didn't have any income taxes withheld from their pay, nor did they fund Social Security. And they only made $5,000, say, in the year, and we'll process their tax forms and hand them a tax bill for about $1,500 when they're actually expecting a refund. And how does that happen? That happens when you get hired and you don't understand the terms of your engagement, and you don't look at your first pay stub to see if any taxes were withheld.
Sure.
That's a huge, huge problem. And so I think it begins and ends with the fact that we're all being sold a lot of things via advertising very successfully, and many of our young folks don't have the resources that they need to find the trustworthy sources that really care about their long-term best interests. And so we're all focused on trying to keep up with our neighbors and our friends who are doing this and doing that, and we're being sold things that maybe we don't need all the time. And so
yeah, and then even to add on to that too, what about even just the daunting task of trying to read? I'm putting myself in the mindset of like an 18-year-old, or let's say, since our audience is a little bit more 25, because I would imagine even older young professionals run into this situation as well, where perhaps they see a W-9 or let's say a W-2 or a 1099, and if you may just highlight the key of tax forms that you generally see, and whether it's a W-2 or the 1099, so that way people could first of all just understand what those key tax forms. I know there's also the 1098, right? What are their responsibilities, and the mere fact that a lot of people don't really even understand what these forms are used for.
That's an excellent observation.
Yeah.
So when you're hired as an employee, you're obligated to turn into your employer IRS Form W-4. And IRS Form W-4 is arguably one of the hardest forms to fill out of all of the tax forms there are. And it became increasingly difficult with the passing of the Tax Cut and Jobs Act of 2017, not to date myself. Right now, for example, you're obligated, perhaps, to share with your employer what your other income sources are when you submit a W-4. And I don't necessarily know if that's right or fair, I'll be honest with you. Do you really want your employer knowing that you have other income streams and that you want extra taxes withheld from your pay with this employer? That sends a certain signal to the employer that perhaps you're not worth developing long term because you might go somewhere else, you have other income streams. So I am a big fan of helping people prepare the W-4 where they don't have to disclose to their employer their other income streams, passive or otherwise, and that they really focus on, if they do have passive income streams, that they make quarterly estimated personal income tax payments. Now that's the W-4 side of things. And so and that's for the employer-employee relationship. Now when you're hired as an independent contractor to do a service, you fill out the W-9 form. And the W-9 form is still a complicated form, not as complicated as the W-4 form, but you do need to disclose personal information to your purported employer, and taxes aren't withheld from that. And so you're obligated to not only remit federal and state income taxes if you're in a state that assesses tax on income, but also to fund Social Security and Medicare. And so when you are an independent contractor, I take the 50, 25, 25, 25 rule and I tailor it a little bit because after you deduct your expenses as an independent contractor, whatever your profit is, 15.3% of it right off the top goes to fund Social Security and Medicare, up to the first $160,000. And then you have to recognize what marginal tax bracket you're going to be in and set aside a certain amount of money. And so I usually say to folks that are independent contractors, particularly those coming right out of school, you're making 10 grand, you're going to owe about 3,500 to 4 grand in taxes. Yeah. And so set that money aside, make those payments to the federal government, to the state government recorder, so that you're not surprised in the spring.
Yeah. And so as you were even talking, so I was kind of visualizing as part of the 50-30-20 rule the needs, wants, and savings and things of that nature. So essentially what you're saying is even on the taxing side, that is part of the needs. That goes to the 50%, I would imagine, of obligation that you have to set aside for. Right? So that's like that allocation that it's like, hey, allocate 50% of your income towards this bill. Right. Yeah. Okay. Makes sense.
Yeah, one of the other questions that we get is, this is my side gig and I got paid in cash. And so because I got paid in cash, it's not income. That's not true.
Yeah.
It is taxable income and it does need to be reported, particularly if you want my signature on that tax form. And then the third item, particularly relevant to cash, because this is a huge enforcement issue right now. If someone hands you more than $10,000 in cash today, you have a very specific and immediate reporting requirement to the IRS. Okay? And I'm sure Ben can speak to that as well. It's a suspicious activity report. We refer to it as IRS Form 8300. So cash is taxable income, and there is a very large enforcement budget looking for cash circulating in the economy right now in exchange for services rendered.
Well, and I know we'll definitely get to Ben, but just in this cash, since we're here on the cash side, there's a lot of jobs that is very cash heavy, right? Waiters and service industries and things of that nature. First of all, like, what is the amount again of cash that is required for you to make in order to for you to file for a tax again? Isn't there's a generally per year a cash amount, right?
$600.
Okay, $600. So if you make less than $600, you don't have to.
Well, okay.
Just for the audience of like.
So the answer to your question is the way the Internal Revenue Code is written and the Treasury regulations are written. You have to report all of your income.
Okay.
Whether or not it's being put on IRS Form 1099 MISC or IRS Form 1099 NEC, doesn't matter. If you make $400, you have $400 of income that needs to be reported unless you have expenses to offset against it.
Yeah. Okay.
Okay. And so there's two standards. There's the information reporting requirement standard that says that income over $600 requires the issuance of IRS Form 1099 NEC. Okay. But that's separate and distinct from the fact that all income is reportable. Internal Revenue Code, Section 61.
Sounds good. And then so speaking of income, when let's say you start making a lot of income, you need a place to deposit this income, right? And that's where the banking side comes into play. So with that being said, Ben, when it comes to banking and banking products, what sort of challenges do you see in your world that either consumers, young professionals kind of, have challenges with?
Yeah, I think, overall, I think the biggest challenge for young people today is probably a lack of financial literacy. Hopefully that's going to be corrected in some fashion with the passing of the House bill last year that's going to require some component of financial literacy for a high school diploma. How individual school districts handle that is still kind of up in the air, but hopefully that'll help a little bit. But I think, it can be a daunting space. You come into a bank, maybe it's a little bit uncomfortable. You don't quite know how to act, what questions to ask. And so I think the biggest difference can come from which bank you choose and how you decide to start your interaction there. And, I always go back to find a bank that is a relational bank that's asking you questions about how are you going to use your money, how are you getting paid, what are your goals, and let your banker help you decide which products might fit your particular banking situation best. Instead of being nervous, going online, picking an account that might not really best fit your particular needs, your spending patterns, or how you're going to access money out of that account, which could have downstream effects for additional fees for services that you're paying for that you could have avoided if you would have been better aligned in the product that you started with. And so I know it can be a daunting space, but my suggestion is come in, ask for help, find a bank that wants to invest the time to ask you the questions about how you're going to spend your money, how you're earning your money, how are you going to be depositing your money. They can help really outline a pretty good financial suite of products that are going to help you best manage your money through your own personal economy. And at least if you start on the right foot, the tendency to trend in the right direction has increased exponentially from the start. If you start on the wrong foot, you either get discouraged or end up costing yourself, unneeded fees and some of those types of things. So really important to start that relationship in the right way, and not be afraid to ask for help, ask questions, and let a professional help you at least start right.
No, great points. And just to kind of get the audience to perhaps know what it could look like to start off on the wrong foot to avoid those fees. What sort of how could that look like so they can avoid doing something like that?
Yeah, I mean, you come in and you open an account and you don't really recognize that it has a minimum balance requirement. And, you're never going to hit that minimum balance requirement through your statement cycle because things are tight and you just don't have the excess cash to leave in the account. And so you're going below that minimum balance requirement and you're getting hit with a fee every single time. So, there's a much better product that's suited for you. That product with a minimum balance requirement might have some additional yield on it, and that might be something that you can graduate into as your income kind of grows and you have a little bit more disposable income, and you can leave it in there to take advantage of some of those products. But unknowingly, you've signed yourself into an account that is going to ding you with a minimum balance requirement fee each and every month, and it's not egregious in most cases, but it's still money out of your pocket for doing that. Also some banks will have different service fees for the way that you're transacting your account, and so you just want to make sure you understand the bank's fee schedule, you understand which fees are associated with the products that you have that are going to best align with the way that you're going to spend your money out of the account and deposit money into it to avoid paying some of those extra costs.
No, and that's so important too. And when it comes to banking products itself, I would imagine just like on the taxing side of things, a lot of people don't know about banking products. They don't know what sort of products to even utilize. So on a high level, do you mind kind of just sharing what sort of banking products that young professionals have at their disposal, and what sort of products can help them build, not necessarily wealth, but just help them along their journey of building wealth, or let's say the financial.
So I think your base two are going to be some sort of a checking account, some sort of a savings account, money market, something that hopefully you can put your 20 or 25% in each and every month. I think the other big thing for young professionals to look into is some sort of overdraft protection, whether that be a line of credit attached to the account or whether it's attached to a savings product in some way. Overdraft fees are one of the easiest ways that young people get into big trouble on the account. They accidentally overspend, and the overdraft fees are aggressive. They are very expensive and costly, and it really creates this downward spiral once you get into that, because it's additional fees. Now your next check comes in and it's already cut because you're paying back a negative balance that you had, and so you have even less, which just continues to exacerbate the problem. So I'd say, some sort of a checking account, some sort of a savings product. Ask your bank about overdraft protection. Some of that you have to qualify for, which can sometimes be tough for people just starting out. Sometimes there's a different product that can manage that. And then, today I think it's pretty standard that everybody's going to use some sort of an online banking product. Really use the alerts and features on that online product to alert yourself when your account is getting low, or to set up, automatic transfers when it's appropriate to kind of help you from there. That's really probably your basic level service: mobile banking, online banking, checking and savings. And then from there, I think it naturally evolves into, basic consumer credit products for credit cards, car loans, personal lines, and that sort of thing.
Yeah, all very super important to, be a consumer in the financial markets, right? So super important. Man, we just kind of touched on a lot of key areas of finances, which is really exciting. So love diving into this. As a financial nerd myself, it's funny, and it's kind of like I've always wanted to envision myself talking to a group of financial experts and talking deep into finances. So this hits really on that nail. Now let's kind of transfer into, or transition into, which I'm sure you guys have heard about, the wealth transfer that's happening, right? So let's talk about that. I know, so there is a stat that says here that according to the Federal Reserve's in a data cited across major wealth reports, over 80 trillion is expected to transfer between generations in the U.S. over the next 20 to 25 years. That's the largest wealth transfer in history, right? So let's talk about what this means to, consumers, right? I'll say starting with you, Connor, since you're the wealth guy. First of all, let's talk about, if wealth is built over decades, where does the journey actually begin, and where do people usually misstep? Now, I know it's almost like a two-part question. Let's first kind of talk about the wealth transfer and what the implications of that looks like. And then I'll perhaps want to go around the room and talk about that, and then I guess we can jump on the second question. Let's start with the first one.
Absolutely. Well, I think, as a millennial, our generation loves to talk about, the individual who bought a house in the 1960s or 70s for a very small price, and now it's worth a lot. A large portion of that, the word trillion is crazy, but a large portion of that is going to be held in a lot of real estate, which will be passed down. But outside of that, there's also a lot of qualified and non-qualified assets, retirement and non-retirement accounts that are going to be passed down along with it too. If you are fortunate enough to be in a position where you can expect that as a young professional, it's important to know what kind of cost that's going to look like to you. John, I'm really excited to hear about your take on this, because it's exciting to know you're going to inherit an IRA account from your late grandfather, but at the end of the day, there have been rules and bills passed, especially the Secure Act 2.0, which now talk about new taxation on a lot of these accounts. And I've worked with a tremendous amount of clients over the last, handful of years who are just absolutely blindsided with this. They anticipated it being one of their retirement accounts, and in many situations you actually need to spend some of those assets down within a period of time. So my advice on that front, Caleb, is, if you are fortunate to be in a position like that, it's critical to meet with your professional A-team to know not only how can you essentially recycle that money into your own financial planning, but also know what is really going to be left over after you pay Uncle Sam his fair share of taxes on it too, because that's critical.
Yeah. Well, Uncle Sam.
Talk.
I'm excited.
I actually heard a very fascinating quip the other day that the new definition of middle class, have you heard? The new definition of middle class is if you're the benefactor of inherited wealth. All the rest of us are just living paycheck to paycheck. And I don't know if that's true or not, but I find it fascinating, and I thought I'd just bring it up right now.
It sounds pretty true. It sounds pointed towards that, but yeah.
But to your point, Connor, under the Secure 2.0 Act, when you inherit a qualified plan, and by a qualified plan I mean a retirement type plan where there's a custodian involved, you generally have to liquidate that plan within 10 years. It has to be fully pulled out and usually 10% a year based on the value on December 31st of the preceding year. You need to pull 10% out. It's called a required minimum distribution. And so that money is subject to taxation. Now, the interesting thing about that dynamic is that I'm 61 years old. My mom's 83, so she had me when she was young. Bless her, but she doesn't have many years left with us. Now, when her children, myself included, inherit her retirement account, I'm at 61. I am pretty much at the highest bracket I'm going to be in from an income tax perspective, and so now I'm having to withdraw 10% of her qualified funds as a required minimum distribution and pay income taxes on that at a very high marginal rate. And so when there is a transfer of wealth, it usually happens that way inside of a family. And it usually happens where the inheritor of that wealth is having to pay very large taxes because they're also still gainfully employed and usually at the top of their game because they've been experienced and around for a bit. So that's one component piece of the Secure Act that's interesting and challenging. The other component piece of it is with regards to real estate. That is how endowed families stay endowed, and it's what's referred to as the stepped-up basis in real estate. What that means is that if you own a portfolio of real estate, heck, if you even own any property at all, it doesn't even have to be real estate, and you pass and you have a bequest to your heirs of that property, the value of that property to the person inheriting it is the fair market value as of the decedent's date of death. And so, to Connor's point, we're seeing people with real estate portfolios that just pass on their real estate portfolios to their heirs, and now their heirs have properties that they can sell with no capital gain tax implication whatsoever because they're new stepped-up basis.
Interesting.
And so this is one of the things that has led to this very profound dichotomy of wealth that we see today in the United States in particular. So generational transfer of wealth is definitely a hot topic tax item to try to bridge that gap and shrink that dichotomy of wealth.
And I would imagine, in terms of I don't know if this is a banking product when it comes to something like a trust. Is that with the wealth transfer, is that what you potentially have to build, or is a trust built by the individuals with the money that are transferring the money? How does that work?
Well, from a tax perspective, there's many different kinds of trusts.
Okay.
And generally speaking, in order for a trust to be removed from a decedent's estate, it needs to be an irrevocable trust, meaning that they lose complete dominion over how the trust assets are spent or are distributed after the trust is funded. A revocable type, grantor type living trust is included in a decedent's estate. And I do want to take one quick mention here and let you know that when you do pass away and you're single, not married, your assets, there's a certain thing called a death tax, and it's about $12.5 million right now. Anything over that is quickly taxed at 40%. And so when it comes to those of us that are endowed and you do have that kind of money, you do really need to have a financial aid team to talk to, not only about investing, not only about banking, not only about taxes, but about estate planning and legacy. Otherwise, the money will go to the government pretty quick.
So. You want to add something there?
It's definitely important to have an estate planning attorney within the conversation and probably even added to this table at some point.
Good call.
To John, your point, there's just so many different ways you can structure, an irrevocable trust. I mean, there's, especially with real estate too, to be able to access some of the rental income, if that's something that you're doing, there's grants, there's slats, but all of them affect the estate planning differently on the back end. But those can be, a trust and will truly could be some of your best ways of hedging and mitigating taxes on the back end of life.
Nice. And just on that high level, for people that hear about those terms but we don't need to get too deep into it, but like, how does that even work in terms of when do you need a trust? When do you need you mentioned a will as well, and feel free to chime in too, Ben, as well. How does that? When do you need it? How does it work?
Well, if I don't.
Yeah.
So the significance of a trust is the privacy involved in transferring wealth at death. It avoids probate.
Okay.
Probate is a process that we have to go through here in Colorado if you pass, and correct me if I'm wrong, I think it's more than $65,000 in your checking account. Then you have to, if you're the executor of an estate or you're appointed by a court to distribute a decedent's assets, you have to go through a public process. And so trust assets avoid probate. And that's one of the biggest significances of having one, I think.
And a probate, just for clarification for the audience.
Probate court is where you go to make sure that when you pass, you're passing with a clean bill of health, that any of your creditors are satisfied, that anyone that wants to lay claim to your assets, and Prince. Do you remember Prince from Minneapolis? He died without an estate. And it became a very public, very ugly clamoring for his assets. And so had he had an estate, had he had a trust, it would have been a very private affair. The public would have been precluded from understanding how those assets transferred.
So it's very important to have these things in place, of course, if you have some money.
Well, if you have the money, and that's a fascinating conversation to have. You can set up a trust on your own if you wanted to. I wouldn't recommend it, but most trust attorneys, your average trust is going to cost between $4,000 and $5,000 to set up. So to your point, if you have the money, but it involves getting a federal employer identification number from the Internal Revenue Service, which, if you're a do-it-yourselfer, you can do that. You need to make sure that the provisions of the trust are in accordance with the state laws that govern that trust, and that's where people get challenged.
Yeah. Want to add anything you want to throw in, Ben, on your end?
I think I take a little bit of a different perspective on some of the wealth transfer. I think it's going to create immense opportunity for younger people. There's going to be a lot of businesses that are transacted, in the near future, and the opportunity for people to buy businesses that they work for or in an industry where they're very interested. And so I think it's going to be a really good opportunity for young people, but that comes with a lot of planning, a lot of pre-planning, and some knowledge about how you can finance some of those things, and working with people to understand if the business can cash flow enough to support the sale price and still leave enough for that individual to get the kind of returns that they would hope for out of that business. So I think we'll see more and more of that, and it's going to be really important that people understand what products and services are available to them that can help with some of that stuff. Have some of that money stashed away if that's kind of in your future plans, is to be a business owner at some point. Really starting to plan for what down payment requirements are going to be on certain transactions, and really start planning for your future, because when it happens, it's going to be a great opportunity for a lot of people out there to get some of these businesses that some of our baby boomers are going to be exiting and selling.
Yeah, that'd be nice. Now, going back to that the follow-up question and this one more, this question is more so for the others that aren't fortunate. I don't know if I want to say aren't fortunate to get to be on the receiving end of the wealth transfer, but more so just regular consumers that are looking to build wealth. So if wealth is built over decades in that scenario, let's say you're not in that recipient of getting some sort of funds, where does the journey actually begin, right? So, and where do people usually misstep? And I would like to get you guys' perspectives on just that wealth journey. Where does it generally begin?
In my opinion, in my profession, I'll answer the latter part of that question first, actually. The biggest misstep is not having a plan. It's not having written down goals. And I think especially for younger audiences, it's so easy to delay putting together, like, hey, here's when I want to retire by, here's how much after-tax monthly income I'd like to see before inflation when I do stop working. Instead, I think a lot of us are caught up in today's world of just like, I need to have money set aside for groceries, or I need to be able to pay off this note or this loan. All rightful fears, but it's heightened urgency now more than ever to make sure that you actually create a plan for yourself. Once you've identified financial goals and how you want to outline your future, that's when the wealth journey can begin. And then from there, you can meet with professionals to really understand what types of products really make the most sense for you, whether it's at your local bank or with your financial advisor, because there's a myriad of different ways that you can build wealth, create it, and protect it for that matter.
Well, and Connor, I think there's so many young people that are leaving free money on the table from day one.
Absolutely.
They're not taking advantage of employer matched contributions. And, anything that you can do that is kind of pre-tax, your budget is sort of built around what your paycheck is. And so if you really are diligent on the front end and putting that money away and taking advantage of all or at least a portion of your employer's match, it's already gone before it hits your account. You don't really have to think about it. And then you build your budget around what you have left. And at least you're investing. And I think the biggest mistake that I see young people making is not taking advantage of those opportunities early, because the downstream benefit of starting investing early is extreme.
Oh my gosh.
I mean, it really is extreme, and it's probably the difference of a lifestyle of when you retire. If you can retire how you want to or how you have to. And I see a lot of young people that really miss that. They don't fully understand the benefit of that. They are just kind of thinking about, can I go on vacation? Can I buy groceries? Can I increase my wardrobe? All these things that you want to do when you start making money and getting a check, they really miss out on that initial opportunity, and those are free funds.
Why do you think that's the case, that they miss out on that?
Well, I think a lot of it is they don't know. They really don't know. I think when younger folks are applying for jobs, they're looking at the salary. They're not looking at the ancillary benefits that come along with that job, in terms of, even if you have two separate jobs that you're weighing, and one pays 100% of your health benefits and one doesn't, that's money in your pocket. You really have to try to to be able to tangibly understand what your employer's benefit package means to you in terms of dollars. If one company is matching 4% into your qualified retirement and one isn't providing a match, that's a real tangible benefit. And I don't think people really look at that. I think they tend to look at salary and other job factors, and that's okay. I wouldn't fault anybody for that. But it might just be that they don't know. And I think the other fallacy is we all think we have a lot of time. And we do have a lot of time. But especially when it comes to retirement, the earlier you get in, it's like time in the market is better than timing the market, right?
Yeah.
And so the earlier you get in, the more benefit you're going to see over the long course. So
Pay yourself first and spend later.
Yeah,
well said, Ben.
yeah.
There's actually, if you look at the math, a 25-year-old who saves and invests their money until 35 is better off than an individual who starts saving and investing at the age of 35 until 65. That 35-year-old who invested for that 10-year stretch with compound interest is going to have more money in retirement, assuming the same rate of return, of course, for each individual, and the same monthly contributions that they were setting aside.
Yeah.
Isn't that amazing?
Yeah. And with all those stats still, it's quite amazing that a lot of, as we were talking about, young professionals miss that. And could it be too because of just the constant inundation that they get with consumerism?
Exactly.
Could that, like, and if that is the case, putting ourselves in those shoes, now, of course, everyone is responsible for their own actions. How would you guys speak to that sort of audience that they're like, oh my gosh, that you're saying the right things, but gosh, I'm scrolling through my Instagram and I see a nice pair of shoes, or or whatnot, and they're if they're constantly, consumerism, right? That's how the economy, operates, through consumer spending. So, at what point is it a healthy consumer spending where you're not, spending so much that you don't have enough to save, and then you can start investing like you guys are talking about, and where you can block yourself from the constant ads and things that are forcing you to spend money?
Well, I think it's a fascinating environment that we live in, and I am thankful that I am not a young adult right now. I'm being sold a bill of goods every time I turn on the TV. Why am I inadequate? Why do I need to spend this money on this to feel better about myself? At the end of the day, I think part of becoming moving into adulthood, into your 30s, is self-reflection. What's in your own heart set? What's in your own mindset? Who do I trust?
Sure.
Do I trust my employer? Do I trust my friends? And really, it distills down to self-reflection.
Sure.
In this environment that we live in, with the developments of the internet and artificial intelligence, we have become increasingly transactional in everything we do and less relational. Ben, you had a very fascinating point about having a relationship with your customers.
Yeah.
I think we all share that, and we build trust amongst our customers.
Yeah.
And I think young people today are challenged in those regards, because there's just so much coming at us, all of us right now. We don't know who to trust.
Yeah.
And so I think to the whole point of why we're together today, the Financial A Team, is to build trust.
Yes, indeed.
Amongst ourselves, amongst our constituents, so that we can offer them adequate advice, and so that we can be the recipients of good guidance for
100%.
Wealth investing, for banking relationships.
Right.
And so that's what I think.
We live in an age of instant gratification, and everything that you want to purchase is literally at the tip of your finger.
Yeah.
I mean, it's crazy when you watch the Broncos on a Sunday. Every ad you see in between the game is essentially about sports betting or a new product, and I see a lot of young professionals, young individuals get caught up in a lot of that too.
Yeah.
Piggybacking off of what Ben said a moment ago, Paying yourself first is so important, and I'd take it a step further. There's the component of the relationship, like what we were just talking about, but layering on top of that, a mechanism of automatic transfers, having everything on autopilot.
I like that.
Getting yourself to do something manually, and going into your account and then wiring from your checking account to a money market or a high yield savings. Thank God your 401k is not a manual contribution and it's just automatically pulled from your paycheck. Otherwise, I'm convinced most of us wouldn't even do it.
I see. Yeah.
So it really is a dual component effort of, you got to have a strong relationship with your financial professionals. And on top of that, you have to automatically pay yourself first, because once that happens, whatever's left over in your checking account where all the money's going in and out, you have a very clean grasp on exactly what you can spend.
Yeah. I like that. Yeah.
It's hard. I mean, I'm pretty diligent and I still fall victim to it where, it's tough. I think we all make a lot of excuses of I work hard, I deserve this, and I do that.
Yeah.
I think, most people, when they look back, would change something. They would wish they started sooner.
Yeah.
I mean, here I am, I have a 17-year-old son, a 13-year-old daughter. We're touring colleges, and I'm looking at the price tag of education, and my wife and I are having the conversation now of like, I wish I could rewind and put away more. Because the cost of tuition has rose so drastically, just in our kids' lifetime. So it's really hard. I don't know if that's as much relationally as it is just individual.
Sure.
You have to really make that choice of how you want to set yourself up. Yeah. How long do you want to work? How hard do you want to work?
Sure.
And really, like to Connor's point, it's not when can you retire, but it's also how can I retire?
Sure.
Do you want to travel? Do you want to keep a membership at a country club? Or do you want to be a little bit less fortunate and maybe you can't do some of that stuff? And so I think that's the bigger question. It's when can I retire and how do I want to retire? Do I still want to travel? How much money do I really expect that I'll need to live the lifestyle that I want to when I retire? And all of that is going to really guide your early decisions for how early you start putting away and how much. It's probably never enough. When you think it's enough, it's probably never quite enough with the rate of inflation and how things continue to go. But
No, and I like to piggyback on your point too, Connor, on the automation part. So I don't know if you guys read the book I don't know if you guys like Ramit Sethi or not, but he wrote a book called I'll Teach You to Be Rich. And in that book, he talks all about automation, the importance of just automating everything, and how, to your point, if you don't automate, it just probably would never get done. So no, that is a good point on automating the 50-30-20, itself. No, these are awesome. We're just touching some great points here. And I want to dive deeper into the overall, like, the financial journey, and perhaps ask a question of, like, why is it that perhaps one professional is not enough to in building your financial journey? Why do you guys think one financial professional will eventually break down?
That's a really good question, Caleb. I would say, in my line of work, I've always been an advocate of having a personal banker and also a tax professional as well too. I'll tell my clients I can help you build wealth in very tax efficient ways, whether it's discussing Roth conversions or making sure we're tax loss harvesting on investments. But at the end of the day, we don't file tax returns. I am legally obligated to tell my clients that I am not a CPA. I'm not a tax professional. It is vital that you work with someone who is, to understand what exactly your tax drag in this situation. So we actually we work with a handful of people just outside of our office, just to help our clients feel more equipped with understanding what they need in that space, and also personal bankers, estate planning attorneys. That's why it's super important to
Yeah.
make sure that you have different professionals. It's not a one-person job.
For sure. And I would imagine you guys as well probably know, John, I'm sure you probably know like financial advisors, or perhaps you, relay some of your clients to different, how does that work on your end?
Well, if I may, I'm just going to share with you a file that I'm working on right now to hopefully personify the significance of having a team. I have a client who inherited 1,000 acres of farmland in Indiana, and from her grandmother. And her grandmother was a wonderful lady. It was very important to this person that when she passes, that none of her heirs were traumatized, that there was going to be a smooth transition, a smooth private transition. So she consulted with an estate attorney and explained to the estate attorney that her goal was this smooth transition. And the estate attorney offered guidance that she should deed the farmland to her granddaughter before death, completely missing out on the stepped-up basis of the value of the farmland. And so now my client inherited this farmland at $8,000 an acre, and is staring down the barrel of a very large tax bill because her basis in the land was the value, her grandmother's basis in the land. When you gift something before death, you lose out on the stepped up basis. Now, had the estate attorney talked to me while drafting up these documents, I would have brought that to everyone's attention. They didn't. So now, after the fact, my client is looking at a very large tax bill, a huge tax bill that could have been avoided.
Yeah.
So that's just one of many examples that I have of consulting with many different.
Yeah, so important. You have any points you want to throw to Ben on
I
the
think
team?
we all do different things. We all have different expertise, and I can't give tax advice, but I can refer people out to get it. And we have a wealth department, but I don't deal in the same types of accounts that Connor does. So really think of your financial team as a source of one to many. And I have clients all the time that come in that maybe they need a certain type of loan, and I don't offer it, or I don't offer it as competitively as somebody else. I mean, my goal is really to see my clients succeed, and if it's something that I can't offer, I'm always happy to pass a referral. And I think all of us would do the same. When you have a really good team, they generally have really good Rolodexes. And whether that's just in the industry sitting around this table or any other industries, if you can use those people as a resource, they can introduce you to a lot of different people that can really help you with what you're trying. I happily refer people out if it's something that I just really can't do, because I want to be the connector to my client. I still provide some value to them, even if I can't do it, to connect them to somebody else that can. And so, if you think in one-to-one, you're going to get one-to-one. And if you think in one-to-many, you're going to expand your network just with the people that you're working with who are also well connected across a spectrum of different industries, and can really help at least give you a couple contacts to pursue, so you're not starting from scratch.
Yeah, no. So important to have that A-team, hence why we're here talking about it. No, this is a great opportunity now to transition into access and trust, right? It's great that we've been doing a really good deep dive into understanding what to do when you have money, right? And all the trust and different systems and things to create and have that team. Now let's talk about, because at the end of the day, the reality is not everybody perhaps has access or perhaps even trust financial institutions, right? So let's kind of talk about that. Where do people misunderstand access to capital the most, and what actually changes the outcomes? So perhaps let's kind of just talk about, just in general, in terms of access to capital. There, of course, are certain people, whether it's communities or whatnot, that perhaps don't have the same sort of access. So what do you guys say about, that sort of conversation that's real, and how could those sort of communities start, working towards getting in the financial system, or learning about how to be, let's say, big drivers in the financial consumer market, things of that nature. Participate essentially in the economy.
It's hard because without having a connection, your first knee-jerk reaction is, well, I'm going to go on Google, or I'm going to use ChatGPT to find the first person, individual, or team that I can find, which sometimes can work, and you might strike some luck and meet a really great professional in that situation. But I've found that some of the best ways to create more access to this world is to seek mentorship through those who you want to be in their shoes of in 10 years from now, 15 years from now. That person that you really aspire to be at work, or want to be in their shoes at some point, ask them what they're doing. Be candid. Practice radical candor about it, and say, hey, you're someone I really want to emulate. I really like what you're doing. You really seem to have it together. Would you feel comfortable sharing with me a little bit more about who you work with, or how you've gotten to where you are financially? What kind of professional should I be talking to that you may know? I really find that a qualified introduction, a really high referred individual can be the best way to create an immediate amount of trust through a nominator. Otherwise, you're really just reading Google reviews outside of that.
And then in terms of the trust aspect too, speak on financial advisors. Do you feel like there is some sort of narrative about financial advisors that consumers perhaps have? And if so,
you don't need to beat around the bush. Yeah, there's a stigma.
Okay.
There are a lot of different advisors out there, frankly, and especially with financial advisors. You want it's imperative to make sure that the individual or team that you're working with is held to what are called fiduciary standards. Therefore, they have a legal obligation to work within your best interests. You have a lot of individuals in this industry running around as representatives or salespeople, masquerading themselves as someone who's going to take care of everything, when in reality they may just pigeonhole themselves into one specific product that they're ultimately trying to lay up. Whether that product may be good or bad, sometimes it just may not be in your best interest, which is why I always go back to, in our approach, having goals-based needs and really understanding what are your finances, where do you want to go. Until I know those two things about you, I cannot make a recommendation, period. So I think, to answer your question, Caleb, going back to that, it's really just, there are great advisors out there. In addition to really leaning into who you want to emulate and getting into their network, getting a referral.
Sure.
I would also make sure that individual or team is held to what are called fiduciary standards.
Love it.
Absolutely.
Love it.
That's an excellent observation.
Yeah.
I do think that seeking mentorship is absolutely 100% the goal, that leads to the trust. I also think that it's a two-way street in terms of helping people, having proteges, being a mentor to someone else. The more you give, the more you receive. It really works. It's worked for me, and I'm hoping it's worked for all of us sitting at this table. And so I can't encourage people enough to help others along, and to be that mentor for someone that comes to you that you trust and want to build a relationship with. And so,
Yeah. Important. Yeah.
Yeah, I think the scary thing is, right, when you look at access to capital when you're just starting, maybe the scarier thing is there is access to capital, but it comes in maybe less desirable forms. So it comes in payday lenders, it comes in credit cards, and I'm not anti-credit card, but I am anti-credit card without responsible education and use. And so you have people who might not trust the systems in place, but they're going to go seek it out. And a lot of that stuff can create a lot of hardship and problems, and it's maybe not the best way to get that capital. I think all of us try to earn trust on a daily basis. I mean, that's part of who we are and what we do. And I think when you find that trusted advisor, the difference is nobody likes to be told no. That's an embarrassing situation for everybody when you go and apply for a loan and somebody tells you no. You know, it's not a great feeling, but the difference really comes on the back end of that, and it can be no, and it's an embarrassing situation, and you leave and you kind of get disheartened about the whole process. Or you can have somebody that sits down with you and says, you know, we really can't approve the credit at this time because of X, Y, and Z. And here's what we can do to fix X, Y, and Z. Here's our next go forward plan. If we need to purchase a vehicle, we have to get our credit score up a little bit. And it looks like we have a couple things that are reporting negatively. You know, can we work on a plan to get some of these collections paid, to get those cleared and at least start rebuilding the credit? Or, hey, your debt to income is just a little bit too high, but if this is paid off, we're there. So let's work on getting this paid off, and then we're there. That's a much different no than the first one. And so I think when you find those people that are building that trust with you, that want to build that future relationship, that's where it's different. The access to capital might still not be there, but they give you a plan on how it can go. What has to change? What do we need to work on to get to a yes, instead of just a no? But it takes both parties kind of coming together, and you know, you really have to kind of go through that exercise and see how that comes out on the other end. So
no, it makes sense, and mentorship for sure, and I'm sure there's a lot of resources, you know, kind of listening to probably, you know, podcasts like WalletGyde, you know, I'm sure helps with, providing financial information to people that could eventually get access to these sort of information that we're talking about. And that's, matter of fact, our mission with WalletGyde, to provide that access. So exciting stuff we're doing here. Okay, so now we're winding down, trust me, but now we're about to transition into, of course, one of the hottest topics right now is AI. Okay. All right. Are you guys afraid of being replaced yet by AI, or?
I have a feeling we're all going to answer that the same way.
So how does AI change the way people understand not just money, or not just to manage, but their money itself? How does AI, first of all, just kind of, what do you guys feel about AI, and then how does AI change how people understand how to manage their money?
So what I meant by, I feel like the three of us are going to answer it the same way is, you know, it's a question we get, I'm sure you guys have been asked so many times as well, but you know, when I get asked that by a client or someone else, it's like, my response is, what do you value most about our relationship? The answer's in the question.
Yes.
You know, AI is certainly going to continue to get to a point where it'll be so evolved and developed where, you know, it's going to feel like you're speaking to a human on the other end. OpenAI and ChatGPT, it certainly is getting to that point, or may already be there. But that doesn't mean that same system is going to hold you accountable. Follow up with you to make sure that you're doing the right things with your money. Or actually feel anything when you tell them that a relative just passed away. You're going through a divorce. You lost a job. People crave relationships, especially in today's day and age where we're surrounded by screens and we don't really get out much at all. I think our profession specifically within this industry are some of the last tethered pieces that people are going to crave to. And I think it really gives us you know, how blessed are we that we're in these positions where people want to work with us. I think it really puts us in a strong position to not necessarily be replaced by AI, but to work with it and help people.
Love it, love it. How do you use AI? What are your thoughts about it?
Don't seek. I've actually challenged clients to do this, to see what AI will say. Like, you have, like, enter into AI, like, hey, what should I do? And you're going to get like a myriad of answers. It's, I I personally use AI. Our firm uses AI to essentially note take and annotate meetings, which saves me a lot of time because that's like 30% of my job is I need to make sure I'm compliantly keeping very, very detailed notes about what was said, what was exchanged in the meeting. And AI has been a huge help there in keeping and probably saving me 2 hours a day on that front.
Wow.
At our firm, we also have our own variation of an internal AI, which we can shortcut to resources for. We have different departments like special needs planning. It's like, hey, in this situation, who should I be talking to in this department to get a very specific niche answer for this client that we're working with?
Okay.
So that's where we're using it.
Nice. A lot of workflow automation type stuff. Okay.
Correct.
Nice. How about you, John? What are your? Is there going to be any tax AI robo?
Yes, there will be.
I mean, there's total tax, but.
Yeah, I think to Connor's point, the fact of the matter is that we are in increasingly a transactional environment across every industry. There will be a point in time in the not too distant future where you'll be able to scan in your tax documents, your W-2, and a program will poop out a tax return for you. So when you are focused on the transactional nature of just submitting your tax forms, that will be overtaken by AI probably in the next 3 to 5 years. Is my job in peril? No, and I'm going to tell you why. Because the lion's share of the value that I bring to anyone is in planning for the future. Planning to pay not a penny more in taxes than what you're actually legally obligated to pay. And it's that planning component piece, not only as it pertains to yourself, but to your families, to your children as you're launching them into adulthood. You don't want them checking the box, or you want them checking the box that they are a dependent of another, particularly if you're still supporting their lifestyle while they're off at college taking naps. I use AI to do tax research presently. I've been training a model for about 24 months now. It is increasingly sophisticated, but it still hallucinates, and I still need to go in and read what it's producing before I share it with a customer or a tax authority or a judge.
Sure. Because
you don't want to be misrepresenting any facts to a revenue agent or having be a tax court judge. So they're evolved. They're not evolved enough yet to keep up with the pace of the changes that we're seeing in tax law, particularly here in Colorado. But eventually they'll get there. At the end of the day, as long as you're focused on developing and cultivating relationships with your customers, you're not going to be in fear or jeopardy of losing your job.
Awesome.
Yeah, I mean, I agree with both Connor and John. I think the banking industry tried a version of this for a while. They had kiosk banking, became a bigger and bigger thing where they tried to eliminate tellers out of the lobby and do everything through a machine. And I don't really think that the customer base responded well to that. I think they still like to know that somebody is handling their transaction, that there is the human component, that there is, that relationship in the lobby. And so I don't worry about it on the lending side because I think that job is so nuanced. It takes so many conversations to really understand the best structure and how we're going to handle the transaction as a whole. I'm sure AI could handle components of that, but to your point, I just don't think it's quite as efficient. We're using it much the same way you are. We've developed our own internal one, and it's absolutely amazing for the data that I can query internally if I'm really looking at some of those types of things. I use it for a lot of market data, but again, you almost spend as much time verifying if the data that you get is correct because you don't want to just use it and kind of put all your faith in that. So, but I think it's going to play a role, right? It's growing so fast, it's going to play a role in all of our lives. It's going to be very interesting to see how that progresses, and I think we'll all have to interact at some level, but it'll be interesting to see how that ends up
Indeed.
playing out.
Hopefully not Skynet. Okay. So we're going to do a rapid fire reality check questions here. And we're just going to run it through, all of you guys one by one. So high energy clip ready. Let's go. So biggest financial mistake young professionals make?
Gosh, point blank, not saving early. Kind of like what we were talking about. I know it's nothing new. It's certainly not sexy, but the harsh reality of this world is the second you find your way into your first job, start saving money, period. Especially if you don't have a 401k. My gosh, find the right products for yourself. Talk to professionals, and start socking away as much money as you can for your future.
I'm going to say two of them.
Okay.
One, not paying your taxes, and two, ignoring that letter from the Department of Revenue. Open the letter. Read the letter. Okay.
Awesome.
I want to hot take listening to financial influencers
Oh
on
my God.
TikTok
Thank
and
you.
Instagram.
Okay.
Please
Yeah.
seek professional advice outside of those platforms.
Yeah. There
It's
you
like
go.
Caleb.
Yeah.
Yeah,
Well, I bring experts on the table, so listen to WalletGyde for sure,
Yes.
because we bring the real truth. One habit silently killing wealth. What is one habit out there that is just silently killing wealth?
I would say taxes and credit card debt,
Okay.
for sure.
Hmm.
Those are the two big bugaboos right there.
Okay.
Too
Taxes.
much screen time.
Okay. Screen
Yeah,
time.
too much screen time.
Too much screen time.
Living outside your means.
Oh.
Mm-hmm.
Oh. Yes, indeed. Wow, those are good ones. I love that. One thing you wish people learned before 30.
How to create an appropriate budget.
I like that.
Self-respect.
Love it.
Please use your employer's matching contributions on your retirement accounts.
Great stuff. Final round. Okay, final round. If you had to give young professionals one rule for 2026, from a banking perspective, Ben, what would it be?
Can you repeat the question? I'm sorry.
If you were to give young professionals one rule or tip, I guess, for 2026, I know we kind of we're going through some there, but what would it be?
In our current environment, make sure you have an emergency savings fund for 2026.
100%. How about you, John?
Reach out. It's okay to ask for help.
Yeah, so important.
It's cliche because it's January, but set some goals for the year. What do you want to accomplish for yourself financially? Is it the right time to buy that house you're looking for? Or, to Ben's point, start building that emergency fund if you don't have one already.
Absolutely. So what's exciting is the biggest, or what's really interesting is the biggest financial gap today isn't income, it's understanding. Banking, planning, and taxes aren't separate games. They're one system, and building your financial A-team is how you stop reacting and start directing your personal economy. So as you guys probably know, I've talked about the personal economy before, your income versus understanding your income and your expenses and your cash flow, and then understanding your assets and your debts and your net worth, and pairing those two, key statements together, you have a really good understanding of your personal economy. That with WalletGyde, that's one of our key focuses. So what I really enjoyed about this podcast is how we literally, started from the pain points, started talking about, real financial issues that consumers go through, and then walking through essentially taking them through this journey, right, that everybody goes through. How do I budget? How do I build wealth? How do I protect that wealth? What are the banking, tools, the advisory insights, right? So this is first of all, like I said, really exciting. It was great to have the opportunity to, sit down with you guys and have this epic podcast. And, hey, I think this is a first, in my opinion, of many that I'm sure we're going to do. So I think we've pretty much covered all the key things here. Is there any other lasting, tips or tricks, or do we look like we've we've pretty much hit the nail on the head here.
Yeah, I appreciate it. It was great to meet you guys and hear your insights, and
Yeah.
always fun to come on and chat with you too. So thank you.
Absolutely. Yeah.
I gotta say, it's been an honor sharing this table with the three of you, and I can tell that you guys are really good at what you do. And, you know, one theme that really seemed to come up a lot today was relationships, and I'd echo that one more time. I feel like that says a lot about this circle right here.
Yes, indeed. Awesome. Yeah.
If I were to say anything, that trust begins with being authentic with yourself.
Yes.
And being authentic with yourself begins with taking time to self-reflect.
Now, I'll say one thing too about AI. AI can't do this, right? You know, and that's one of the key things with WalletGyde. We say we're high touch or high tech because for sure we are building financial chatbots. We're there. We're in high tech as well, for sure. But we're also doing this. You know, being high touch, creating that community. You know, so really excited about it. And yeah, so we are over and out.